In the last video, I showed you what happens when you buy an in-the-money call. In our case, we're buying the July 48 strike price calls on June 16th. We bought the Julys that had 29 days left in its expiration, and we had a profit of $509, as you can see down here in the right-hand corner. Now what I want to do is look at the example of taking an at-the-money option and see what the difference in both the percentage gain and the dollar gain that we would experience as the market rose. Remember, we were looking at the Qs. We were looking specifically at a range of prices that we saw that the market was ready to turn around and go higher here, and riding it up to the top of this little rally here that the Qs experienced. So if we go back now, we want to take a look at the money options and see how they differ in when you purchase an at-the-money option rather than in-the-money option. When we were doing the in-the-money option, we wanted a delta of at least 88 or 90 to 90, 91, 92 at the most. That's where I like to stay, because you tend to get, number one is you don't want to pay for more delta when you're very close to 1 anyway. So if you get an 88 or a 91, it's very close to the 100 delta, and you don't want to pay more than you have to in order to get that type of delta. So now we're going to be looking at the at-the-money option, which is the 55. It has a delta of 38, so that means for every dollar that the Qs rise, this option will gain 38 cents. Now, since we're dealing, each option represents the right to buy 100 shares of the stock, the underlying ETF, it would rise $38 for every dollar that the Qs rise. That's how you would calculate it. You calculate the 38 times 1 times 100, and the 1 is the number of option contracts that you have, and the 100 is the number of shares that you can actually purchase with each contract. So we're going to go ahead and purchase that. Now it gives us the price here on the we're using the Think Back section of the Thinkorswim platform, and what it allows you to do is go by date, whatever date you put into it, to determine how well your strategy would have worked in the past. And that's exactly what we're doing. Now we know that in the chart, we hit a low here on June 16th, and then we rallied. So with great hindsight, we are going to try to profit from that. If we so we got a price of 77, which is the split between the bid and the ask. The bid is 75, the ask is 79 cents. And we're going to go, instead of going through every single date, we're just going to go straight through to our ending trade date, which is July 7th, and see how well we did. We know that July 7th was a temporary halt to that rally that we noticed. Now we've got a profit of $357, not as good as in total dollar terms as the $509 profit that we had when we purchased the in-the-money call. However, on a percentage basis, since our original price was only 77 cents, that represents a much higher percentage gain, one that we purchased in the money. In fact, it's over a 500 percentage gain on that particular option, and it was just over a 250% gain on the option that we bought that was in the money. So although it only cost us $77, it returned a profit of $357. So it's a fairly good trade. However, there's one thing that, of course, that we had in our favor, and that is hindsight. We knew that the market was going to rally strongly and very sharply, and that's the only time that an at-the-money option would actually profit, if there's a very, very strong move coming. Now, if we didn't have a very strong move, if we just moved sideways or we moved down a little bit, that option would have expired nearly worthless. It would have eroded over time, losing money on a daily basis. So keep that in mind. whereas the in-the-money option eventually would have lost less value if the market just went sideways or up slightly. And in fact, if it just went up a little bit at a time, rather than a roaring rally, you would have maintained its value and maybe even made a small profit on it. All right, let's look at now purchasing an in-the-money put, and let's see what would happen if, in fact, you purchased a put thinking wrongly that the market was going to go down instead of up, and let's see how much money we would have lost. Now, I like to purchase, as I said, I like to purchase in-the-money options with a delta between 85 to 92. So in this case, we're looking at probably a purchase of the 58 puts. So go ahead and purchase one of those. It split the bid and ask again. And many times you can get the split in the bid and ask. If it's bidding 405 and it's asking 417, sometimes you can put it right in the middle. The Thinkorswim platform, this ThinkBack facility, automatically splits the bid for you. But sometimes in a fast-moving market, it's almost impossible to get that split. But you can try it first. You might even have to go after the bid, actually, when you first start to put in your bids. We'll talk more about trading strategies and exactly how to enter orders in a later video. Now, here we bought the put. We know that a strong rally. We bought it at the same time. We thought the market was going to continue lower, and instead it roared higher. And let's see what happens. We're going to go straight to our termination date on our trade. And you can see that we lost $393.50. So being in the money, we definitely lost money, about $400. We were wrong. The market roared higher. But that's pretty much of our maximum loss. I mean, we would have had to sit through this entire rally all the way to July 7th, which is this minor top here. And if you were losing money on this trade, you probably would have set a stop loss someplace around here, which would be June 27th. I doubt, I mean, a good trading strategy, remember, the number one rule is preservation of capital. So if the market starts to prove that you're wrong, it's a good idea to set a stop loss someplace to get out. In this case, we probably would have set the stop loss on June 27th when it rose above that minor high. If we go to June 27th, a more realistic loss point is $132.50 for an in-the-money option.